preparing for a performance analyst interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share. And drop a topic request in the comments. Question 1. What does a performance analyst do in an asset management firm? A performance analyst turns portfolio activity into reliable performance insight. I would calculate returns, validate data, compare results with benchmarks, and explain drivers through attribution and risk measures. The role sits between investments, operations, client reporting, and compliance. Good analysts do not just produce numbers. They challenge breaks, understand methodology, document assumptions, and help portfolio managers and clients see whether returns came from skill, market exposure, or cash flows. While answering, focus on return calculation, data validation, benchmark comparison, attribution, risk analysis, client reporting, and the need to connect investment performance with portfolio decisions and operational accuracy. Question 2. What is the difference between time-weighted return and money-weighted return? Time-weighted return measures the manager's performance by breaking the period around external cash flows and geometrically linking some period returns. Money-weighted return, or IRR, reflects the actual investor experience because it depends on the size and timing of cash flows. For evaluating a portfolio manager, I would usually use TWR because the manager often cannot control contributions and withdrawals. For private equity or client-specific outcomes, MWR can be more relevant. Make sure to cover how TWR neutralizes external cash flows, how MWR reflects investor timing, when each measure is used, and why asset managers usually prefer TWR for manager evaluation. Question 3. How would you choose an appropriate benchmark for a portfolio? I would start by matching the benchmark to the portfolio's mandate, not just its historical correlation. A good benchmark should be investable, transparent, measurable, and aligned with the portfolio's asset class, region, sector, currency, and risk profile. For example, a global equity portfolio hedged to USD should not be judged against an unhedged local currency index without understanding the mandate. If the benchmark is wrong, active return and attribution become misleading. In your answer, talk about benchmark relevance, investability, transparency, style alignment, currency, region, asset class exposure, rebalancing rules, and how an unsuitable benchmark can distort active return and attribution. Question 4. Can you explain performance attribution in simple terms? Performance attribution explains why a portfolio outperformed or underperformed its benchmark. In equity attribution, I would typically separate allocation effect, which is the impact of overweighting or underweighting sectors, from selection effect, which measures stock picking within those sectors. If a manager overweighted technology and technology outperformed, allocation helped. If their technology stocks beat benchmark technology stocks, selection helped. Attribution converts a return number into an investment story. Be sure to mention that attribution explains sources of relative performance, including allocation, selection, interaction, currency effects, and how it supports portfolio manager review and client communication. Question 5. A portfolio return in your report does not match the portfolio manager's number. How would you investigate? I would not assume either number is wrong immediately. I would first confirm the period, gross or net basis, valuation point, portfolio scope, and return methodology. Then I would reconcile market values, cash flows, trades, income, corporate actions, prices, and FX rates. If those agree, I would check fee treatment, accruals, and benchmark or carve-out assumptions. Once I find the driver, I would document it clearly and explain the impact before the report is finalized. While answering, focus on a structured reconciliation approach. Source data, valuation dates, cash flows, pricing, FX rates, fees, benchmark versions, methodology differences, and clear communication before publishing. Question 6. What do you know about GIPS standards, and why are they important? GIPS stands for Global Investment Performance Standards. They create a consistent framework for presenting investment performance fairly and comparably across firms. The key ideas are proper composite construction, consistent return methodology, full disclosure, and avoiding cherry-picking strong accounts. From a performance analyst perspective, GIPS matters because institutional clients and consultants rely on credible historical performance. It also forces strong internal controls around data, calculations, policies, and record retention. Make sure to cover fair presentation, full disclosure, composite construction, consistency, comparability across managers, required policies, and why GIPS matters for institutional clients and consultant due diligence. Question 7. How are daily portfolio returns calculated when there are external cash flows? At a basic level, daily return compares the change in portfolio value after adjusting for external cash flows. A simplified formula is ending market value minus beginning market value minus net external flows, divided by beginning market value, with timing assumptions depending on the system. If a large cash flow occurs intraday, a more accurate method may create a sub-period return. The objective is to avoid treating client deposits or withdrawals as investment performance. In your answer, explain beginning market value, ending market value, external flows, income, fees if relevant, timing assumptions, and why large flows may require sub-period calculations. Question 8. When would you use Modified Dietz, and what are its limitations? Modified Dietz is useful when I do not have daily valuations, but still need a reasonable return estimate over a period with cash flows. It weights each external cash flow based on how long it was invested during the period. The method is practical and widely understood, especially for monthly reporting. Its weakness is that it assumes a linear return pattern, so accuracy declines when markets are volatile or when large cash flows occur at unfavorable times. Be sure to mention that Modified Dietz approximates money-weighted performance by weighting cash flows, is useful when daily valuations are unavailable, but becomes less accurate with volatility or large flows. Question 9. How do currency movements affect portfolio performance measurement? Currency can materially change reported performance. A foreign equity may rise 5% in local terms, but if its currency falls against the portfolio base currency, the investor may earn much less or even lose money. I would separate local asset return from FX translation effect where possible. I would also confirm whether the portfolio and benchmark are hedged or unhedged. That distinction is critical because currency exposure can be an intentional investment decision or an uncontrolled reporting effect. While answering, focus on local return versus base currency return, FX translation, hedged versus unhedged benchmarks, currency attribution, and the distinction between asset performance and currency impact. Question 10. How would a stock split, dividend, or corporate action affect performance reporting? Corporate actions must be captured correctly because they can create false gains or losses. In a stock split, the price and quantity change, but economic value should not. For dividends, total return should include the income component, while price return would not. I would verify the security master, ex-date, pay date, tax treatment, and position adjustments. If a corporate action is missed or duplicated, performance may show an artificial jump that has nothing to do with manager skill. Make sure to cover accurate security master data, price adjustment, income recognition, reinvestment assumptions, position reconciliation, and why corporate action errors can create artificial performance spikes. Question 11. What data checks would you perform before publishing a performance report? Before publishing, I would run both completeness and reasonableness checks. I would reconcile market values to the accounting book of record, review large cash flows, identify missing prices, stale prices, failed trades, unusual FX rates, and securities with extreme returns. I would also confirm benchmark data, fee basis, and prior period restatements. Finally, I would compare results to expected portfolio behavior. Strong performance reporting depends as much on clean inputs as on the calculation engine. In your answer, talk about NAV and market value reconciliation, pricing exceptions, cash flow reasonableness, stale prices, FX rates, benchmark data, missing securities, outlier returns, and sign-off controls. Question 12. Which risk-adjusted performance metrics should a performance analyst understand? Returns alone do not tell the full story, so I would look at risk-adjusted measures. Sharpe ratio compares excess return to total volatility, while information ratio compares active return to tracking error. Alpha measures return beyond what beta exposure explains. Maximum drawdown helps show downside experience, which clients care about during stress periods. These metrics help answer whether performance came from efficient skill, broad market risk, concentrated bets, or simply taking more volatility. Be sure to cover Sharpe ratio, information ratio, alpha, beta, tracking error, downside risk, drawdown, and how these metrics add context beyond absolute or relative returns. Question 13. Explain tracking error and information ratio to a non-technical client. I would explain tracking error as how differently the portfolio behaves compared with its benchmark. A low tracking error means the portfolio stays close to the benchmark. A high one means the manager is taking bigger active positions. Information ratio then asks whether those active risks were rewarded. If a portfolio beat the benchmark by 2% with low tracking error, that is stronger than earning the same 2% with very unstable relative returns. While answering, focus on plain language, active risk, consistency of outperformance, benchmark relative behavior, and why high active return must be evaluated alongside the risk taken to generate it. Question 14. What is a composite, and why does composite construction matter in performance reporting? A composite is a group of portfolios managed to the same strategy or mandate. Composite construction matters because it prevents a firm from showing only its best account and calling that representative performance. I would expect clear rules for when accounts enter or leave, minimum asset thresholds, fee treatment, and handling of terminated portfolios. Proper composites give clients a fair view of how a strategy performed across actual accounts, not a selectively chosen track record. Make sure to mention grouping portfolios with similar mandates, avoiding cherry-picking, applying consistent inclusion rules, handling account openings and closures, and supporting fair comparison under GIPS-style standards. Question 15. A portfolio has a positive absolute return but negative alpha. How would you explain that?
Positive return does not automatically mean strong relative performance. If the portfolio gained 8% but its benchmark gained 12%, it underperformed on a relative basis. If its beta suggested it should have earned 10% given market conditions, then alpha may be negative even though the client made money. I would explain that absolute return answers, did we make money? Alpha answers, did we add value versus the risk and benchmark we were hired to beat? In your answer, talk about the difference between making money and outperforming expectations, benchmark return, beta-adjusted return, market environment, client framing, and avoiding misleading conclusions from absolute returns alone. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.